yet. Certainly, many of us have twins fever, and sadly, many of us have tax fever. And we want to do everything in our power to pay the government everything we owe and not a penny more than we owe. And that can be more of an art than a job. Joining us from the CenterPoint Energy Home Service Plus hotline is Jackie Lee from Baker Tilly, talking about taxes and the changes ever since the big 2018 tax cut, still reverberating through the economy. Jackie, thank you for joining us on CCO.
Thank you, Paul. Nice to be here.
Absolutely. We want to talk a little bit about personal returns and also business returns. We have a business segment every Wednesday called Mind Your Business. And let's start with business, if that's okay. I know there are a couple of things, deductions for pass-throughs, first-year bonus depreciation, net operating loss changes. Can you summarize, if you have a smaller business, and 95% of U.S. businesses are pass-throughs, what should people know?
Right, that's a great question. And as you mentioned, tax reform, which happened in 2018, obviously those effects are still in play here for 2019. But the main thing for small businesses to keep in mind is really to think about the types of fixed assets they're purchasing. You had mentioned bonus depreciation. You're exactly right. There's an opportunity to deduct 100% of the cost of certain fixed asset additions during the year. They have
100%. That's huge, because you had to string that out over multiple years before, right?
That's correct. So if the assets fall into a class life that's less than 20 years, and most assets are usually 5-7 years, you get that deduction all in the year you purchase the asset versus having to depreciate that over a longer period of time. So it is definitely a benefit for small businesses.
And net operating losses can no longer be carried back for 2 years, right?
That's right. There were some changes with regards to net operating losses that would impact corporations. And you're exactly right. There used to be a carryback period that no longer exists. However, there is no longer an expiration on carry forwards. So for those operating losses that businesses incurred in 2018 and going forward, they have an indefinite carry forward period. So that's definitely a plus. The one item to keep in mind is it used to be that you could offset 100% of your taxable income with your available losses. And starting with 18 net operating losses and going forward, you'll only be able to offset 80% of taxable income. So that's a little bit of a change on the corporate side.
Got it. Talk a little bit about international exposure. I know when it comes to international taxes and regulation, it gets really convoluted pretty fast. What advice would you have? Because even small businesses now that either buy components from overseas or sell overseas have some exposure and have to take this seriously, right?
Correct. Tax reform did really change the whole tax concepts regarding international activity. And so my advice for folks is when they are looking at the operations of their business and when they start to venture overseas, whether that is, to your point, purchasing product, selling product, perhaps you have people over in Europe, I would really suggest you consult your tax advisor because there can be ramifications to that. There could be situations where you're subject to tax in local country jurisdictions. So it's really something to focus on and take seriously.
We're talking with Jackie Lee from Baker Tilly about tax implications. We're heading into that season right now. Can you talk briefly, Jackie, about the SALT cap? As of 2019, as of last year, filers can only deduct up to $10,000 in state and local property and income taxes. And I know there's a fair amount of complaining about that in the great state of Minnesota. What can you tell us about that?
Sure. As part of tax reform, one of the changes that happen for individuals is when you itemize your deductions, You're correct. Your limit on deducting state and local taxes is capped at $10,000. And so that is a combination of not only income taxes, but also real estate taxes, personal property taxes. And so for businesses that are what we call flow through in nature, LLCs, S corps, where those state taxes come through on the individual's 1040, that is a big limitation. However, to offset that, you mentioned this earlier, another change in tax reform was the qualified business income deduction of 20%. And so there is a little bit of a balance there. You lose out on the state taxes, but in a lot of situations, those flow-through type entities can benefit from this 20% deduction.
Jackie, talking about personal returns, switching gears, pivoting away from business now, personal returns, what is the number one mistake that most people that you've seen over the years make? I mean, what are the deductions that people are not taking, are not aware of? What advice would you have to people? What's the number one thing?
Sure. Well, some of the big items that people can take deductions for that sometimes can get overlooked would be things such as if you are part of a high deductible health plan and as part of that, perhaps you have an HSA account where you put dollars aside to pay for out-of-pocket costs. You know, those dollars people are putting aside are deductible. And for a family plan, you can deduct up to $7,000. And so oftentimes people may not be aware of that if they're paying for those costs out of their pocket. If people have an individual health plan, meaning they're paying for it out of their pocket 100%, you know, again, that's another deduction that people should be taking on their 1040.
Good advice. I long for the day I want to live long enough to do my taxes on an index card and send them in. I don't think that day is anytime soon. What do you advise people? And people pride themselves, and I envy people that can do their own taxes. When should you get serious about having a professional accountant, a CPA? What's kind of the pivot point where you say, you know what, I just don't want to do it myself because I don't want to step in it? What do you tell people? When is it time to turn to a CPA?
That's a great question, Paul. And what I usually tell folks is, you know, if you're an employee and you get a W-2 and maybe you're able to itemize your deductions and you get your mortgage interest statement at the end of the year and things of that nature, that's all pretty straightforward. I think when people can fall into trouble is when they are perhaps a sole proprietor, so they aren't filing a separate business tax return, but the activities of their business are being reported on their 1040, and maybe they're really good at what they do, but they're not great at bookkeeping and kind of understanding the income and expense components that need to be tracked. You know, we talked a little bit about depreciation. That can be challenging for people to track going forward. So I think the big thing for people to be aware of is if they're operating a business, it's best to focus on the operations of the business and, you know, let a tax preparer handle all those details that you probably don't really want to deal with anyway.
Amen. Well, great advice, and thank you for taking time with some important reminders. We've been talking to Jackie Lee from Baker Tilly. Jackie, I wish you the best, and pray for spring, okay?
Sounds great. Thanks a lot, Paul.
Thank you, Jackie. When we come back,